The Dow is down 800 points. The world is in a literal panic over a global health crisis, and the experts on TV are telling you to run for the hills. But in a quiet room in Omaha, Nebraska, the richest investor in history is doing something that would make most people's blood run cold. He's not selling. He's not even worried. In fact, he's doing exactly what he's done for the last 80 years to build a billion-dollar empire while everyone else loses their shirt. Today, we are breaking down a rare deep-dive interview with Warren Buffett during one of the most volatile mornings in stock market history. We're going to look at why he thinks reaching for yield is the stupidest thing you can do, the secret book that changed the world of investing, and the one yellow pad exercise he says you must do before you buy a single share of stock. If you want to know how to turn a market crash into a generational wealth opportunity, you're in the right place. This is Investor Corner. Before we dive into the Oracle of Omaha's playbook, do me a quick favor. If you want more deep dives into the strategies of the world's greatest investors, hit that subscribe button and ring the notification bell. We're building a community of disciplined investors here at Investor Corner, and we'd love to have you on the team. Now, let's set the scene. It's early 2020. The coronavirus is just starting to shake the global supply chain. The markets are cratering, and Warren Buffett sits down to explain why your perspective on stocks is probably all wrong. The interview starts with a bombshell. The interviewer asks Buffett if the 800-point drop is a reason to panic. Buffett's response. He takes us back to March 12, 1942, the day he bought his first stock. He bought in the morning, and by the evening, he was down 2%. The world was at war. Things looked bleak. But Buffett explains that the biggest mistake investors make is looking at a stock as a price that zigzags on a screen. Buffett, people would be better off if they say, I bought a business today, not a stock. If you buy a farm or an apartment house, you're going to own it for 20 years. Has the 20-year outlook for American business changed in the last 24 hours? This is the core of the Investor Corner philosophy. Buffett mentions American Express and Coca-Cola, companies he's owned for 20 and 40 years respectively. He's not trading headlines, he's owning cash-generating machines. If the business is still going to be dominant in 2030, a price drop in 2020 isn't a loss, it's a sale. One of the most practical gems in this interview is what I call the yellow pad test. Buffett argues that if you can't sit down with a piece of paper and write, I am buying this company for X billion dollars because, and then list the fundamental economic reasons why, you have no business buying it. He uses General Motors as an example. He says back in 1932, during the Great Depression, GM was selling almost no cars. It looked like a disaster, but that was the best time to buy. Why? Because you aren't predicting what the market does next week. You are predicting what the earning power of that business will be in a decade. Key takeaway. If you need the newspaper or a YouTube influencer to tell you if your stock is good, you haven't done the yellow pad test. Buffett then highlights a forgotten book from 1924 by Edgar Lawrence Smith. This is crucial for understanding why stocks outperform bonds. Smith realized that even if a stock and a bond have the same yield, the stock wins. Why? Because of retained earnings. When a company makes a profit, they don't give it all back to you in dividends. They keep some to buy more machines, build more stores, or buy back their own shares. This creates a compounding machine that bonds simply can't match. However, Buffett issues a stern warning about low interest rates. He calls reaching for yield incredibly dangerous. If you need 5% to live, but the safe rate is 1%, don't go chasing magic investments that promise 5%. You'll likely end up at zero. He famously says, eventually you get to midnight, and everything turns to pumpkins and mice. So, what can we learn from the Oracle's 55th year at the helm of Berkshire Hathaway? 1. Stop watching the ticker. Start watching the business. 2. The 20-year rule. If you aren't willing to own it for 10 years, don't own it for 10 minutes. 3. Cash is an option. Buffett has $125 billion in cash. He isn't missing out. He's waiting for the right price. Markets will always have trouble. Whether it's 1942, 2008, or 2020, there is always a reason to be afraid. But as Buffett shows us, the winners are those who can write down their reasons on a yellow pad and wait for the world to realize they were right. I want to hear from you. What's one stock you'd be comfortable holding for the next 20 years, regardless of what the market does tomorrow? Let me know in the comments below. I'll be jumping in to reply to the best ones. Thanks for watching Investor Corner. If you found value in this breakdown, give us a thumbs up and check out our other video on stay disciplined, stay patient, and I'll see you in the next one.